This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian equities are set to open mixed as Wall Street traders lifted stocks away from session lows. Treasuries rallied across the curve. But Netflix is rising in after hours after dropping out of the fight to buy Warner Brothers. That clears the way for Paramount to clinch the deal with the studio. An IDC report warns that the global smartphone market will contract this year due to an unprecedented memory chip shortage. We'll be breaking down that issue with the Bloomberg Tech Asia later with IDC's Devices Research VP Brian Ma. Plus, we'll be watching oil amid signs of progress in US nuclear talks with Iran. Both sides continue negotiations of a deal.
Yeah, and it's the easing of geopolitical tensions around Iran that actually sent U.S. stocks higher. So we have that positive sentiment coming over from Wall Street. We have already seen record highs across Asia. We're talking about Japanese stocks, Korean stocks, in fact, the most overbought in a long time, above that 80 level on the 14-day RSI. You can see Nikkei futures under a little bit of downside pressure early in the session. We have seen a little bit more strength on the Japanese yen. So after 3 sessions of gains already, really boosted by exporters. We'll see if that dampens a little bit of that optimism in the equity space. We had heard from a local media report quoting Governor Ueda as the BOJ being on that tightening path, saying that he'll continue to assess the impact of the December and earlier rate hikes as well. We have seen the ASX 200 not doing much early in the staggered session, but do watch out for the Aussie because traders are the most bearish on the Aussie in about 3 months. And this after that significant rally when it came to the Aussie. Same thing for the Chinese yuan, which is at a 2023 high, Haidi. But of course, the tech sector very much in focus given Nvidia slump overnight.
Despite those, yet again, impressive numbers, Shery, right? We were talking about this yesterday. Is this sort of the respite that the market needs away from the AI scare trade? It doesn't look like it. Still that sort of fear and disappointment playing. Nvidia shares sliding after the forecast relief felt like it underwhelmed investors. We saw the stock suffering the worst decline in 10 months. The latest forecast really failing to dispel these ongoing sort of almost existential fears about an AI bubble being built and the questions over the sustainability of gains as well as spending in the sector, right? We saw the company's shares really declining about 5.5%. Still, that is despite the numbers that we saw yesterday in the earnings, easily beating the average analyst estimate, a 73% surge, just to remind you when it comes to fourth quarter revenue, but still that wasn't quite enough to really strongly reassure investors about the booming AI spending story being justified. We also did have some numbers when it comes to the broader economy. We had US jobless claims edging higher, 100,000 in the holiday week was what came through. So that still sort of indicates broadly that layoffs remain relatively low there. So continuing to watch the eco data, claims data can be volatile around the holidays as to that sort of potentially feeding through to what we see from the Fed. We've also got some corporate headlines. One of the big movers is, of course, at the moment, Netflix declining to raise its bid for Warner Brothers. They've called the deal no longer financially attractive. So take a look at that. We're seeing Netflix off the session highs. We saw a surge of about 12% post-market on the news, pairing that, but still up by almost 10%. Warner had earlier said that Paramount's latest takeover is a superior proposal. So we'll see probably that start to make more progress. Paramount seeing some modest gains, but Warner Brothers a little bit softer there.
And Haidi, to our top story as well as we continue to follow the latest on the memory chip market, the global smartphone market could end up contracting nearly 13% this year. Researcher IDC says the memory chip shortage, which is affecting every corner of the electronics industry, is creating a crisis like no other. For more, let's bring in our Asia tech correspondent, Annabelle Drulers in Hong Kong. Annabelle, we've been following the memory shortage situation very closely, but this really affects almost every sector of tech, doesn't it? What does this forecast tell us?
Yeah, it's really quite a foreboding one, these numbers that have just come out in the last couple of hours from IDC. So as you said, that headline figure, they're looking at a nearly 13% contraction. In terms of what that means for actual devices being made, so they're now looking at around 1.1 billion smartphones to be shipped in 2026. That's down from 1.26 billion the year prior. But importantly as well, you're erasing what's been years of gradual gain. So it really just tells us exactly, Shery, as we've been discussing for weeks, if not longer, longer, months now really, is this looming memory chip crunch and the impact that it's having. Of course, it's most notable in DRAM, but we have seen prices rising across in other categories, NAND, for instance, as well. And that is certainly having a bearing and having a bearing on the smartphone manufacturers that need to adapt the way that they produce, the types of devices that they're making, and also what they're trying to push to consumers as well. But just to, again, reiterate from IDC, the severity of the situation in their eyes, they're actually saying that when you compare it to the tariffs, when you compare it to the pandemic, those really just pale in comparison to the severity of the situation now that they say could actually last well into 2027.
The impact of the shortage, though, is it highly asymmetric at this point?
Yeah, this is one of the more kind of interesting nuances, I think, to it, just in terms of which smartphone makers actually fare better or worse, essentially, because IDC crunches the numbers here on the cost structure of a smartphone and essentially the total bill of materials. And they're saying that when you look at the more mid-range devices, memory makes up around 15 to 20% of the total bill. But when you go into the lower-end devices, or higher-end rather, you've actually got 10 to 15%. So when you're a higher-end device manufacturer, you're actually better insulated. So names like Apple, for instance, Samsung, yes, they're going to be facing pressures from this, but they've also got deeper pockets. They've got those long-term supply agreements in place as well. The low-end market, though, manufacturers in this area are going to be disproportionately affected. So you're seeing, for instance, production there of Oppo, and Xiaomi as well. You can see some of their devices versus Apple here, but essentially names like TCL, Realme, Xiaomi, Lenovo, Oppo, Vivo, Honor, Huawei. Of course, some of these makers have premium products, but a lot of their focus has been on lower tier consumers instead. And this is where they're actually going to have to really consider, can they actually make these devices moving forward? Because IDC is saying that if you're pricing a smartphone below $100 a device, that is actually now uneconomical to maintain.
Annabelle Jewelers there, and Annabelle will be back because we'll be digging deeper into IDC's report with the group's vice president, Brian Ma, on Bloomberg Tech Asia in the next hour. We'll also break down the winners and losers of the memory chip shortage with Macquarie Capital's Daniel Kim. And as we continue to watch this tech divergence, very much in focus with Nvidia slumping, also software and IT companies actually surging. Memory chip makers in Korea, of course, in focus, given what we're seeing in the shortage situation right now. Let's bring in Bloomberg MLife Strategies, Brendan Fagan, for more on this. Brendan, so it was really an interesting dynamic in the overnight session where we had these AI bubble fears, but at the same time, software stocks gaining ground. So explain to us what happened.
Well, I think the best way to describe it is we sort of have this barbell trade that's going on right now. At one end, you have the AI trade. At the other end, you have the software trade. And when one does well, the other doesn't, and vice versa. And we saw that today. And I think it's just a case of software's been so beaten down. If you look at the IGV software ETF, if you look on a 1 month basis, over 40 names in the basket are in a bear market just in the last month. And then over the last year, it's over 70. So it's a sector that's under pressure, that's beaten down. And I think it's just getting to the point now where people might be saying, how cheap is cheap enough to step in and maybe nibble at the margin?
And at the same time, we're seeing that 10-year reaching the year's low at the same time that we see the slump in tech, right? What do we potentially expect going forward here?
Well, I think the elephant in the room is the pushback on the sell America narrative that has permeated for much of the last year. It shows that in a risk-off tape, which we had over here in the States all day, still people flock to buy treasuries, and that's the case here. But as we approach this 4% level in tens, it gets a little interesting. There's this disinflationary force when you think about AI in the long run, but we still have resilient growth and an inflation problem. So there's this push and pull on the curve across all tenors that makes the conversation interesting, especially as we approach these inflection points.
Yeah, and we also saw the dollar under a little bit of pressure. What's happening around the U.S. dollar trade? Because it seems that it continues to face these structural headwinds, and even any little bit of a rebound fades.
Yeah, the dollar's in an interesting spot. It seems wherever you look across the dollar basket, there's a story everywhere. There's a story in Australia with a resilient RBA and a hawkish RBA. There's a story out of Europe of optimism and stretch positioning there. So it's different everywhere you look. But if you look at the dollar specifically, we're stalling around the 50-day moving average. And that's a key technical barrier that I'm looking at for the last 5 or 6 days. And we really seem to be running out of steam. But the dollar has held up really well. So once again, just like I said with rates, it seems to be this push and pull. We're sort of in no man's land, kind of waiting for that next nudge for the next move higher.
When it comes to the Aussie dollar, we're seeing quite a lot of bearishness over the next 3 months, right? Is it just the sense that the Aussie has rallied too hard, too far?
I think that's part of it. That stretch you're talking about is in the Aussie dollar positioning. I think if you look at Aussie Kiwi, it's even more extraordinary. And that's just a divergence in central bank policy. But I think over the 3-month time horizon, you're getting in a little bit of a dollar reprieve. But also coming up regionally, you have Trump traveling to China, and that could permeate across regional FX. So stories coming out of China during Trump's visit may weigh on the Aussie dollar specifically. So I think traders may just be covering their tracks here going into that next month.
Bloomberg MLive strategist Brendan Fagan there. And speaking of some of the stocks that we're watching in Australia, of course, keeping an eye on the currency as we get into trading today. But some idiosyncratic stock stories. Virgin Australia down by 0.6%, joining Qantas with a warning when it comes to costs to airlines. We're seeing a bit of softness there. Coles, one of the biggest losers, off 7% in that first few bits of trade there. Supermarket sales meeting estimates there, but clearly some concerns over the sustainability of that demand. Commonwealth Bank of Australia, CBA, is in focus for the wrong reasons as well in the session, putting a probe into a potential scenario when it comes to home loan fraud, according to reporting from the AFR. So we'll be watching that very closely, particularly, of course, with the intense focus of what we see with anything properly related in this market. Coming up on the Asia trade, as nuclear talks between the US and Iran progress, Miller Centre's Rudman joins us to talk about the geopolitical impact. We'll also be getting the global economic outlook. Citi's global chief economist will be with us talking markets as well with Eastspring Investments. This is all ahead on the Asia trade. This is Bloomberg. Take a look at oil prices at the moment as we continue to wait for more progress when it comes to those talks with Iran and the US. Oil is just fluctuating in the previous trade. Traders kind of passing the competing headlines that we've had, the status of negotiations between the two nations. We are seeing a little bit of sort of uncertainty as to where these talks go. We've also got the scheduled OPEC Plus meeting on Sunday as well to set supply policy for April. So not just geopolitics, but some of those sort of bread and butter levels when it comes to events for oil. But let's get back to these Iran talks, and I want to bring in Mara Rudman, who's a practitioner, senior fellow at the University of Virginia's Miller Centre. She previously held senior Middle East diplomatic roles in the Obama and Clinton administrations. Mara, great to have you with us, and we know that these talks will continue over the next few days. What's your sort of best assessment as to what's happening at the moment, and what level of negotiations and I guess minutiae might actually be being discussed right now?
Thanks. Well, first of all, it's good to be back with both of you. And I think I guess the best thing I can say right now is that it's a good thing to hear talks are continuing. In other words, that next week, in the coming days, the technical teams from both the United States and Iran, of course, mediated by Oman, will be together and meeting on details. So that's certainly more promising than hearing that things fell apart today. That said, there's still a lot of opaqueness involved. These are very high-risk negotiations, and with a very much decimated U.S. team of expertise to help to navigate this, and a tremendous amount of U.S. military resources out in the region right now as these talks are going on. So it's a challenging time.
And of course, what we're hearing from these talks so far in Geneva have been conflicting at times, right? Positive, very intense and serious. We've heard another report saying that the US side has been disappointed. What do you make of the expertise that's being brought to the table here, particularly as leading up to this, there was a lot of confusion even amongst US lawmakers as to what the administration wanted or what the president wanted from Iran?
Right. I think there's still confusion about what the president's ultimate goals are. As we know, in his State of the Union address earlier this week, he was not the paragon of clarity on this issue, and I would say on other issues as well, but with respect to Iran and why the United States is involved. So it seems that the talks, or reporting on the talks, have been primarily or exclusively on the nuclear issue, which is clearly a key threat to the United States, to others in the region. But so is Iran's ballistic missile ability and its support for militias throughout the region. And so difficult as it may be to get to resolution on the nuclear issue, and I think there's some framing out there that points to a possible pathway, it's still highly problematic when the other two areas are not covered.
In the meantime, we continue to see the U.S. building up its military presence there. We're told it's the largest since before the Iraq War. We were just hearing from analysts, Pentagon's first kamikaze drone unit also being deployed. How much does this threat of a military strike make a difference to Iran when we have seen those targeted attacks back in June didn't necessarily change the game?
Right. Well, I think the Trump administration is clearly calculating that the threat will impact Iran's behavior and increase their willingness to negotiate. I'm not sure that, I don't think that assessment is shared by a number of other analysts. That said, reporting from today's round of conversations makes it seem that Iran is looking to make progress on these talks, is looking at different formulas that may allow President Trump to declare victory and yet still allow Iran to continue to function, both keeping the current regime in place, lifting sanctions, and having a very small, a very low level of enrichment going on with their nuclear activities. Very unclear, again, whether this will satisfy the Trump administration or all of the different players in the Trump administration, particularly when a subject like ballistic missiles may be off the table. Secretary Rubio, for example, has indicated that's highly problematic.
What's the state of the Iranian regime now, especially after the serious unrest, the most serious in decades that we've seen within the country?
So the regime is clearly clinging to power, has tremendous, the population is under tremendous economic duress, in large part because of the sanction regime that's in place, and is clearly, as the protest indicated, there's a high degree of dissatisfaction with the regime. But the regime's response to these protests was so draconian. Tens of thousands of people have been killed. And so they are, I believe what they were trying to do is show very clearly that they will not easily be removed. And I think one of the calculations and negotiations, such as those that are ongoing now with the Trump team, is if this regime is about its own preservation above all else, what levers do you have in terms of what you want to try to accomplish and how?
Why is the Trump administration focusing on Iran now? I mean, we do have an ongoing war with Ukraine. We do have the tariff wars ongoing as well. Why now? What's changed?
It is unclear. Certainly the threat that Iran poses has been consistent. And as President Trump himself said as recently as his State of the Union address, he repeated that the United States had played a major role in obliterating all of Iran's nuclear capacity. That clearly wasn't the case, though Iran was significantly set back, and they have repeatedly shown their ability to send forward ballistic missiles that have great regional, that are tremendous regional threat. And they're also continuing to support, though albeit at a reduced level, militia activity in the region, for example, the Houthis in Yemen. So there are very real threats there. But why now with President Trump is much harder to calculate. And some of the concern, certainly that those outside the administration have, is that he may be drawing the wrong conclusions from his activities with respect to Venezuela and removing the Venezuelan leader Maduro in what was a very successful military action, very risky but successful in terms of getting Maduro out and in terms of how the Trump team negotiated who's in control in Venezuela. And it would not be wise to assume that same approach would work in the same ways with respect to Iran.
How much of a strong hand do you think the Trump administration, the president, has when it comes to foreign policy strategy at the moment? We know that he's facing lower approvals and ratings and some issues back home. What sort of picture do you think would be being painted from the Iran side as they go into further negotiations?
So I believe President Trump has not shown signs of modulating his actions based on what popular opinion polling shows in the United States about what he is doing. He puts himself and his own interests, and I believe probably in his mind somehow the interests of the United States front and center. And so it's very hard for an outsider to get into that mindset and understand exactly what he's doing and why he's doing it. But I would not, I think it would be not a wise assumption to believe that President Trump is somehow going to pull back from the international space because domestically he's facing a high degree of unpopularity.
Ma'am Rudman, really good to have you with us, practitioner, senior fellow at the Miller Center, and you can actually watch other interviews, not to mention live streaming news, Bloomberg TV shows, documentaries, all of this just in one place. Check it out at bloomberg.com/videos. This is the Asia Trade.
The top global headlines that we're following today, U.S. House Democrats are demanding that President Trump testify to Congress on his ties to the disgraced financier Jeffrey Epstein. That's after former President Bill Clinton and his wife Hillary both agreed to be questioned by a panel investigating the so-called Epstein files. The panel's top-ranking Democrat representative, Robert Garcia, has argued that Trump should also testify since he actually appears more times in the files than the Clintons. The Trump administration's move to ease fuel shipments to Cuba's private sector is said to be part of a plan to make it more reliant on the U.S. for supplies. Sources tell Bloomberg the strategy includes reassuring energy companies that they can sell oil and fuel to the private Cuban small and medium-sized business sector and authorizing limited resales of Venezuelan oil. The move seeks to increase Washington's leverage to bring about political and economic change on the island. China has removed 9 military lawmakers from its national parliament in President Xi Jinping's latest purge of key defense establishment personnel. State-run Xinhua News says those affected include the ground force commander and the information support force political commissar. The report did not provide reasons for the removals, but it does come just weeks after an investigation into the top general, Zhang Yuxia. Afghanistan has launched a large-scale military operation along its border with Pakistan, targeting army centres. The attack comes after Pakistan carried out a series of airstrikes along the country's eastern border earlier this week. Pakistan says it killed 36 Afghan Taliban fighters in its response, while losing 2 of its soldiers.
And still ahead on the Asia Trade, we have eco data out of Japan, and Citi will be with us to crunch the numbers. We'll also get their outlook on the global economy. This is Bloomberg. We have breaking news out of Japan. We are getting the Tokyo headline CPI growth of 1.6%, an acceleration from the previous month, also coming in above economists' expectations. When you take out the food prices, core CPI year-on-year is acceleration of 1.8%. This is a deceleration from the previous month, but it's also coming above economists' expectations. Take out the energy price as well, and you're seeing an acceleration of 2.5%, which is, again, above economists' expectations. This is surprising because we had seen the Takaichi administration implement some new energy subsidies. We were expecting the inflation numbers to decelerate for Tokyo, but it's still coming in above economists' expectations. And this is, of course, after we already saw the national key inflation gauge easing to the slowest pace in 2 years. So this will have implications for the Bank of Japan, and obviously what happens here in Japan with JGB yields and also the Japanese yen has global implications as well these days. Let's bring in Nathan Sheets, global chief economist at Citi. He previously served as the undersecretary of the U.S. Treasury for International Affairs under President Obama. Really good to have you in Tokyo today.
Thank you.
Especially on a day when we have the Tokyo CPI, which kind of gives us an indication where we're headed nationally. Yeah. What do you see in terms of the Japanese government and this potentially virtuous cycle of finally some inflation?
My sense is that finally we can say that Japan has entered the post-deflation chapter of its economic evolution. And I think the data that we received this morning underscore that reality, that you've got a solid Japanese economy. We wouldn't say that it's red hot by any stretch of the imagination, but it's solid. The consumer seems to be proceeding at a pretty solid pace as well, supported by ongoing wage gains. And then you have the administration of Prime Minister Takaichi. And we think we're going to get not a disproportionate amount, but we think we're going to get some fiscal stimulus. And that should also provide support. And I think it allows the BOJ finally to start, thinking more deeply about maybe even a neutral rate.
Exactly. But is the BOJ headed in that direction? Does this pace and caution from the Bank of Japan make sense to you?
So on the one hand, moving toward normalization, moving toward that neutral rate is precisely what I think the BOJ should be doing. Now, the cautiousness, I think, reflects the reality that Japan has struggled with low inflation, disinflation, even deflation for a generation. And Governor Ueda and his colleagues want to make sure that as they normalize, that they're not moving prematurely. But I think more and more we're seeing evidence that the economy is solid enough that they can normalize.
If this is a path understood by most people, why is the yen continuing to be so weak?
I think it's just this ongoing reality that the level of rates in Japan is lower than it is in other major economies. And I think also the markets are a little bit impatient, that markets are looking at the current distribution of economic performance, and there is an increasing case for the BOJ to normalize. And it puts the BOJ kind of in a tough place, where on the one hand, they want to be cautious and make sure they don't move prematurely and somehow forestall these gains that we're seeing toward a reflationary economy. But at the same time, as Ben Bernanke said 20 years ago, no central banker can be indifferent to the value of the currency. It's a tough place for the BOJ.
It's a tough place for the global economy and for the US economy, right? Possibly more so for the global economy, given the uncertainty of tariffs and what they look like, with all of these different legal mechanisms potentially still going to be challenged. And Nathan, I wonder, how muddled do you see that picture and the impact on inflation, demand, supply, and the rest of it?
Well, what is certainly clear is that global developments, and particularly U.S. tariff strategy, is a source of uncertainty for the rest of the world. I think the best response is what Governor Ueda has signaled, is that we're going to keep our eyes riveted on the incoming economic data and the performance of the economy. And I think the good news is that in 2025, we saw a lot of this policy uncertainty, we saw a lot of tariff uncertainty, and nevertheless, we continue to see an ongoing resilient global economy. And I think that's the good news, even as the underlying uncertainties about policy and tariffs end up being ongoing challenges for us.
You've talked about perhaps the need to start looking at the types of exogenous triggers or shocks that we could be setting up for. Do you think investors, economists are being sort of too sanguine about the risks at this point?
This is an issue that we spent a lot of time thinking about and candidly struggling with. That over each of the last 4 years, we've started in a place of being pretty cautious about the global outlook and about the outlook for markets. And in each of the last 4 years, the global economy has ended up performing in a favorable way, with growth essentially at trend. So on the one hand, we say, wow, there is a lot of uncertainty out there. There are a lot of things to be concerned about: tariffs and government debt and AI valuations. On the other hand, we've seen the global economy shake off a lot of shocks. The economic effects of Russia-Ukraine and rapidly rising central banks, and we're just talking about tariffs, and continue to perform well. So how you balance those two realities of, on the one hand, this is a pretty challenging world, and on the other hand, the global economy has been able to absorb it and adjust flexibly. And I think that's what we struggle with, and that's what the markets are struggling with. So it does seem like some of the valuations are a bit aggressive, but on balance, it's a tough call.
Isn't that scary, though? I mean, to think that this time is different, because every time it hasn't been different. Does artificial intelligence change the game a little bit, though?
AI is changing the game today, not so much due to higher productivity. I think we'll see the higher productivity from AI several years down the road. But where I think AI is very much a huge part of the story is in investment.
Right.
For the United States, AI has been a major driver of growth, and for trade. For broad swaths of Asia, the AI trade, AI exports are a key part of production.
And because of that production veering towards HBMs and more advanced chips, we're seeing like the basic memory chips actually, this massive shortage crisis. And those go into everybody's consumer electronics. Inflation, isn't this a problem as well?
Critical point that on the one hand, some of the key AI-centric inputs are in very high demand. And that gives the firms that produce them significant pricing power. But we are also seeing in some of the economic data, AI investment crowding out investment for other kinds of even electronics. And there will be winners and losers going forward in this ongoing deployment of AI technologies.
The question, of course, is everyone's trying to look at if they can predict who the winners and losers are, right? And we had that big reaction to the Shery blog post. I do wonder, have we reached a point where we can confidently model the impact of AI on things like the labour market and productivity? Do you think we're on the right track there?
For productivity, I'm pretty comfortable that it will be a significant lift. That during the internet integration period in the late 90s and early 2000s, we saw productivity higher by roughly a percentage point. I think we'll see something at least as large from AI. So on that score, I feel comfortable about my modeling. But the labor market and the implications there, that is the big unknown, is with other new technologies. In every case, the new technologies have generated a huge number of new jobs. And our challenge in thinking about AI is, well, what are those new jobs going to be?
And what are the jobs that actually lose out and disappear?
It's easier to think of those. It's harder to think about the new jobs that the AI ecosystem is going to be.
Which are the most impacted then?
I think that there are vast swaths of knowledge-centric kinds of white-collar jobs that are going to be adversely affected by
Journalists,
AI.
media.
And I think a sad reality of this is a lot of them, at least in the first wave, are likely to be more junior-level jobs.
Right.
And that's something we hear a lot about AI is the seniors are fine. It's the juniors where AI will be doing the work. But then where's the next generation of seniors going to come from?
If you don't train
no one can
the
answer
juniors.
This question.
And also what was really interesting to me, because here in Asia, like the investments have gone to growing, younger, emerging economies.
Yes.
But if AI changes that and you don't actually need more population, isn't this also the resurgence of the likes of Japan, Korea, China, more than so India and younger populations like Southeast Asia?
This is another, let me even call it a mega trend, that I spent the decade between the GFC and the pandemic studying and speaking about adverse demographics and how adverse demographics were going to reshape the global economy. And why? Well, there weren't going to be enough workers. Well, now along comes AI, and maybe we don't need as many workers as we did before, and concerns about global aging and aging in specific countries like Japan, China, Korea, maybe those challenges are now much less acute.
So great timing for you to be in Japan with that macro conference at Citi. Nathan Sheets is a global chief economist at Citi. Thank you so much.
Thank you.
And of course, subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can dive into any of the securities and Bloomberg functions that we talk about. Also send us messages and you can become part of the conversation. This is Bloomberg.
Well, the bidding war for one of Hollywood's biggest studios might have reached its final act. Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch the deal. We are just getting an update at the moment where Warner Brothers holder Ancora has called the Paramount deal a win-win situation there. We've seen Ancora Holdings really making a splash by showing up in some of these high-profile M&A situations, including this one. Let's get some more details on this with Bloomberg's managing editor Lucas Shaw for more. We're clearly seeing the stock reaction across the three different players at the moment in the post-market session, but what do we know?
Well, we know you just said Paramount has won the bidding war, at least for now. They raised their offer earlier this week, and Warner Brothers said that it could lead to a superior offer. Then it said it was a superior offer, and within an hour or two of that, Netflix pulled out. Netflix co-CEO Ted Sarandos was in Washington, D.C. at the White House earlier today. And they clearly decided they didn't want to get engaged in another bidding war.
Is this superior because of the money? Is it more about synergies? Or what is it that this offer is better?
The Warner Brothers board is not really concerned about synergies. I think that if they could have chosen between the two buyers, they preferred Netflix. Netflix is a bigger, stronger, healthier company. But Paramount ultimately offered more money. The reason that Warner Brothers chose Netflix in the first place, other than it being a good deal, was that there was sort of certainty of, they were not concerned, I guess, about Netflix pulling out. They were worried about Paramount pulling out of the deal. They were worried about whether Larry Ellison, who's kind of who's father of David Ellison, the CEO of Paramount Skydance, and the family that is going to control all of this, that he might pull out at the last second, much as his friend Elon Musk tried to do at Twitter. So over the last couple of months, you've seen Paramount say and change its deal to allay many of these concerns while also offering just a little bit more money to make their deal superior to Netflix. And a lot of Warner Brothers shareholders preferred Paramount because Paramount's buying the whole company. So they get bought out right now with cash, whereas the Netflix deal was more of a two-step process where Warner Brothers was going to have to spin out its cable networks and then sell the rest of the company to Netflix.
How does this change the landscape for this space, right? And does it sort of give us an indication of how difficult perhaps further M&A transactions might be?
Well, it creates, we're seeing Paramount and the Ellisons pursue a strategy that others have done, which is you just try to consolidate, right? You have Warner Brothers and Paramount are both companies built on cable networks that are shrinking. They have streaming services that are kind of third-tier services, considerably smaller than Netflix and Amazon and Disney. And so they're hoping that by joining forces, they will get the scale that they need to compete. We've seen this happen a few times already, and it hasn't really worked. AT&T bought Time Warner, then Time Warner, or what was Time Warner, merged with Discovery to create Warner Brothers Discovery. Now we're taking a third crack at it, right? Paramount Skydance is the result of the merger of CBS Viacom and then Paramount and Skydance. And so we keep having these legacy media companies get together with the hope that they will then have the scale to compete. Obviously, the market in Hollywood would like to have there be a number of strong competitors, but the jury is out because this will be a heavily indebted company, and there's a lot of job cuts to come.
Bloomberg's managing editor Lucas Shaw there with the latest on this corporate saga. There's more corporate stories right now that we're following. Anthropic rejecting the Pentagon's latest offer to defuse a standoff over conditions. The company has sought governing the use of its AI software by the military. The company says the new language proposed by the Pentagon as a compromise failed to satisfy Anthropic's desire to preserve key safeguards that it sought for any military use of its AI tools. Those include prohibitions on mass surveillance of Americans. Shares of Block closed higher in the U.S. after the company moved to cut its workforce by nearly half as the company bets on AI changing the future of labor productivity. Block has invested heavily in AI tools to run more efficiently. The company has been restructuring its business model and staffing since 2024 as the company's stock has lagged. Syngenta Group is set to be renewing its bid to go public, this time in Hong Kong. Sources say it may raise as much as $10 billion in what could be one of the city's biggest listings. A Hong Kong listing would give Syngenta access to a wider global investor base and allow it to tap Chinese domestic demand. We have more ahead. This is Bloomberg. Breaking out of Japan, industrial production disappointing to the downside, growth of only 2.2% month on month. This is much lower than economists' expectations, and yet it's an acceleration from the previous month because the previous month we're in contraction territory. Deceleration when it comes to the year-on-year number, though. Growth of only 2.3% and also even below much below what economists had expected. The expectation was for 5% growth. We're also getting retail sales numbers right now. 4.1% growth for January month on month, 1.8% year on year, which is a surprising acceleration on spending. So this is an interesting dichotomy here because you're seeing industrial production disappointing, but actually spending gaining ground in Japan, despite the fact that we do have potentially more price pressures for Japanese households. Let's actually discuss all of this and bring in Chief Asia FX and Rates Correspondent Ruth Carson. Interesting here because we have seen the acceleration of manufacturing in Japan because of all of the global trade backdrop, the tech boom at the same time, but not necessarily household spending.
Absolutely. So we've seen some mixed bag figures there that's come out on Japan data. Traders will definitely be passing all these very, very closely for clues on what that means, not just for the yen, but the BOJ's policy path. So it's important to remember that in many aspects, the yen is caught in this tug of war. Inflation is real. In Japan, inflation is biting the hip pockets of people, but, growth is typically good for a currency. It means, tighter monetary policy as well. The question, though, on investors' minds is the BOJ hiking quickly enough? And also whether the yen is, continues to be the prism through which investors show whether it's their pleasure or displeasure at what they're seeing in Japan.
And The yen is headed for its worst month since November. We're off, almost 1% against the dollar. We've seen dollar yen grinding higher as well in recent weeks. What's the kind of macro thinking here for traders?
A good way to look at this would be what's happening in the options market and what investors are sort of betting there. And the last time I checked, option traders are penciling a higher chance of dollar yen heading to 160, by June than it would to 150. So what does that tell you? It means that the bearishness continues on the yen. Yes, the yen is heading towards its worst monthly loss against the dollar since at least a couple of months, November. So could this be a repeat next month around this time when we have a chat? Haidi, I think that's up for debate, but definitely there are more bears than bulls at the moment when it comes to yen trading.
Ruth Carson, good to have you with us. Bloomberg Chief Asia Effects and Rates Correspondent there with a reaction on the markets given all of the numbers that we just got out of Japan, which is, as I mentioned, really interesting because despite the price pressures that we're seeing in the Japanese economy, retail sales managed to grow 4.1% after a contraction in the previous month. It's also way above economists' expectations. On the flip side, when it comes to manufacturing, factory output, in fact, yes, acceleration, but only of 2.2% month on month, which is really much below economists' expectations of growth of more than 5%. So at a time when we've had strong exports here in Japan because of the technology boom, AI, optimism, of course, this is an interesting divergence when it comes to these numbers. You can see Nikkei futures at the moment down 0.7%, but this after 3 sessions of gains already for Japanese equities. Of course, we have seen this massive gain, Heidi, when it comes to exporters because of a cheaper Japanese yen against the U.S. dollar in recent days. But overnight, we had a little bit of a bump when it came to the yen because of some comments from Governor Ueda on the tightening path.
What's really interesting, you talked about divergence and the split, right? We're seeing this split when it comes to views on the Japanese economy and the best policy rate forward to deal with the rising inflation picture. We heard from the biggest hawk on the BOJ, Hajime Takada, renewing that call for the board to raise the interest rate, saying that inflation is heated to the core. So we continue to watch that emerging split between more aggressive advocates, or hawks of policy normalization, and the government, of course, pressuring that pro-stimulus position as well. We have that March 18th to 19th policy meeting. They are still expected to keep policy on hold. But as you said, Shery, we are seeing a pretty sort of down day across the board. That Nvidia picture really didn't help adding any sort of long-term respite to these markets.
So U.S. futures really under pressure right now, and we'll be watching the tech sector across Asia today as we're watching also the memory chip shortage, and we'll be discussing that on Bloomberg Tech Asia in the next hour as well with these guests. This is the Asia Trade. We're counting down to Asia's major market opens. We're firmly focused on the U.S.-Iran nuclear talks, but with that not necessarily going anything other than the fact that they will continue to talk, the focus back on tech, and we saw that divergence with Nvidia slumping, but then software stocks rebounding.
Yeah, the respite didn't last, or really, I mean, if you take a look at Nvidia, how it started trading on its own impressive numbers, it really didn't go anywhere fast, right? That fear clearly is still there. Software, though, as you mentioned, seeing something of that bounce back. So the divergence continues, and we continue to see the divergence when it comes to Japan as well, whether you talk about the eco data or the prospects for what the BOJ might do.
Yeah, definitely, which was why we've been really watching the Japanese yen strengthening in the previous session, because we heard comments by Governor Ueda to local media about the tightening path. But at the same time, of course, we had a massive rally when it comes to exporters, those that are benefited by a cheaper yen, because we continue to see this weakness. Even with those gains in the Japanese currency, we're still very close to that 156 level. We're seeing now a session of decline for the first time in 4 sessions. expectations. We're still trying to digest all of the eco data that we got earlier. Tokyo inflation, for example, we had seen the deceleration, but still really not matching economists' expectations, which will give us an indication of where national prices are also headed. Industrial production disappointing economists' expectations, not to mention that retail sales surprisingly surprised to the upside, which is saying something because we had been watching household spending because of price pressures in this country. The 10-year yield holding at that 2.14 level as we continue to watch for any changes when it comes to spending and the fiscal policies of Prime Minister Takaichi. Take a look at how Korea is trading, because that market has been on a tear, right? We're talking about record highs, 6 sessions of gains. We're talking about overbought territory in the 14-day RSI, above that 80 level already. Finally, a little bit of consolidation, some pressure early in the Asian session with the Kospi down more than 1%. But these are the stocks that we're following, Samsung, SK Hynix, because we continue to get indications that memory chip prices and that shortage continues.
Yeah, and as you mentioned, we do have quite a high degree of vulnerability and volatility at this point with these Iran-US talks being ongoing as well. But let's take a look at what we're watching when it comes to the Treasury space. And there's a lot of focus on upcoming auctions, particularly as we see that move in the 10-year yield. So this continues to really move in line with what we're seeing with the sell-off in tech stocks in particular, reaching the year's low as those stocks continue to fall. So the lowest level since November is what we're seeing when it comes to Treasuries, and really across maturities, we're seeing quite a significant decline there as well. Watching oil, as Shery mentioned, not much certainty as to what we're getting out of these Iran-US talks. We've heard them being described as intense, serious, positive. We're now also seeing potentially the option still of military strategy not being taken off the table either. And we're seeing equity futures at the moment really seeing a bit of a jolt to sentiment for the S&P. And let's bring in now Ken Wong, who's an Asian equity portfolio specialist at Eastspring Investments. So, Ken, there's a lot going on, and yet sort of, I guess, a lot to be seen still at the same time, right? What's your major focus at the moment?
Yeah, there's a lot of things going on. And obviously, we're continuing to look at whether or not the dollar continues its weakness. Obviously, looking at various central bank policies to see, where they're going to be heading, whether it be in the U.S., in Japan, and some of the other countries here in Asia. I think also because we are in reporting season, it's going to be very important to see where guidance is going to be. The fact is that here in Hong Kong, we've already had quite a bit of reporting that's been happening, and over the next few weeks, we're going to be seeing quite a bit more as well. So, all eyes are on, when everybody's talking about AI and AI capex, I think at the same time, it's also very important to focus on earnings growth, earnings visibility, and more importantly, in 2026, whether or not we can actually see even, further earnings spike and earnings rise because of potentially, more capital flows coming in, additional capex in non-AI related sectors, and then really to see also from employment figures as well as overall economic growth, how those all combine to see, overall earnings wise from bottom up, which companies are going to be winners in 2026.
And it is really in Asian equities as well as rates that you see that potential for outperformance on the re-rating and the upwards revisions of earnings expectations. Are there markets in particular or sectors in particular that you like? How do you feel about tech, for example?
I mean, we've already seen it, right? The fact is that year to date, we've seen how Korea and Taiwan continues to be very strong, especially around the hardware side. Japan also has been quite strong. The key underperformers this year so far has been China as well as India. I think so right now, a lot of eyes are on, whether or not we get a bit more AI fatigue. The fact is that, we've already seen a bit of pullback previously over the past few weeks around software names. Hardware name continues to be fairly strong. But with that said, I think it's going to be very important to see post kind of, sort of the AI kind of boom, and specifically in terms of, stories around the whole AI capex, and then looking more focusing on the delta on the increase in overall capex spend. I think all eyes are very much going to be focusing on over the next few weeks. We've got the big meeting coming up in China. I think, and again, more importantly, as I alluded to earlier, earnings is going to be important. So, when we look at short term, we still very much like Korea and Taiwan for its overall hardware plays. But, when we look at some opportunities, looking at bottom-up stock picking and looking at, some of the underperformers, we feel that, within China A space, we look at some of the China hardware tech names, and then also the India domestic plays have been key laggards. In 2025, they were key laggards. Even so far in 2026, they've been laggards. So those are opportunities we're looking at, very closely to see whether or not opportunities continue to present itself to be very good, attractive entry points.
And India has been a laggard for a good reason because they don't have that much exposure when it comes to AI plays that have dominated the narrative, right? So when you're looking for opportunities in the Indian market, what sectors are you looking at?
Yeah, it really is. When you look at overall cyclicals or when you look at specifically financials and real estate, these are still continue to be key areas. The fact is that when you look at overall valuations for the India market as a whole, it's still roughly around 20, 21 times forward earnings. So from a lot of investors' standpoint, they see that as quite expensive. But with that said, there are still opportunities. And as I mentioned earlier, when investors are still looking for growth, when they're still looking for specifically fairly robust growth and a very good earning streams, the fact is that when you look at the financials, when you look at Indian banks, or when you look at the growth of the Indian domestic real estate sectors, those are really key areas that we're looking at. Yes, while India has a very large population and people still do focus quite a bit on its consumption ability, the fact is that overall valuations in either the consumer discretionary or even more so in the consumer staple space in India are a bit stretched. So, we're mindful in terms of certain sectors in India a bit more expensive. But again, as I alluded to earlier, financials as well as real estate sectors do look to be sort of where the opportunities are.
Which is really interesting because that seems like the complete opposite call for China. I mean, you talked about China earlier and you just mentioned the tech names, but when it comes to some of the other industrial names, anything related to the property sector slump that we continue to see, is there anything other than tech that's attractive in China?
There is. I mean, the fact is that when you look at overall, especially over the past couple months, there has been a bit of a pullback along the AI-related names, especially on the software space in China. But with that said, within the commodity space, so when we look at materials companies, when we look at potentially some of the financials, maybe the non-banking financials prior to this week, they've done quite well as well. And then we're also looking at some of the industrial names as well, which could pose as opportunities for investors. So, over the past couple of months, we definitely have been seeing a bit of, reduction in beta. Some of the investors looking at some of the other opportunities, especially some of those which have been, I would say, very much laggards over the past 18 months or so, which had started to, see some daylight in terms of, investors looking and bottom fishing to try to look for better opportunities.
Ken Wong, always good to get your insights. Thank you. Asian Equity Portfolio Specialist at Eastspring Investments. And of course, we continue to talk about tech because it's really about these suppliers across Asia, especially across Japan and South Korea when it comes to these big names like Kioxia in the memory space, Sony in the component space, and of course, the likes of Samsung Electronics, SK Hynix. It's a broad down day today, but we have seen this incredible growth in this market, haven't we? I mean, considering the AI boom, the really infrastructure build out that we're seeing around the world. But at the same time, because of these issues around the investment, around artificial intelligence, we have seen a lot of reallocation of manufacturing capacity away from consumer electronics. So now IDC coming out with this report that the global smartphone market will contract almost 13% in 2026 because of the memory chip shortage. Let's actually discuss all of this with Asia Tech correspondent Annabelle Jewellers in Hong Kong. And Annabelle, of course, in Bloomberg Tech Asia, will be discussing some of the winners and losers. But this IDC report, pretty interesting. Take us through some of the numbers.
Yeah, it's perfect timing, really, for our next episode of Bloomberg Tech Asia. But going through this report, because as you said, it's really that knock-on effect that you're seeing from the memory chip crunch generally is going to have a bearing on how many smartphones could be produced or will be produced this year, according to IDC. So they're looking at smartphone shipments to come in at 1.1 billion. That's down from 1.26 billion the year prior. And importantly as well, you're erasing what's been gradual gains over the years. So it is also going to be disproportionate. I think that's one of the more interesting notes that come out of this report as well, because that the cost structure of a smartphone is very much dependent on the type of memory that's used. And so for a mid-range device, memory might cost up to 15 to 20% of the total bill. Higher end devices, it's more around that 10 to 15% mark. So companies like Samsung or Apple actually might end up being better shielded. The ones that are going to be most at risk are ones that are producing smartphones for that lower tier market, essentially. So names like TCL or Realme or Xiaomi, Lenovo, Oppo, Vivo, Huawei, yes, they may have that premiumization strategy. Some of them were higher end models. A lot of them are actually still catering to again, that lower cost structure or lower tier consumer, essentially. And so that is going to have a big impact on their margins. IDC is saying that any smartphone that's priced below $100 is now essentially uneconomical.
Meanwhile, we had Chinese tech giant, I should say, Baidu, reporting that numbers out overnight. It continues to be a struggle.
Yeah, that's right. It's an interesting one for Baidu as well, because I think last year we actually started to see that narrative sort of shifting around Baidu a little bit. There was a very significant run up in the stock, but again, it sort of seems to be that bigger focus that we see, which is that Baidu faces a lot of challenges. It was an early front runner in the AI race in China, but its AI tool Ernie has given up a lot of ground there. And then there's also concerns around its search tool losing relevancy, particularly among younger internet users. And then at the same time, that also cannibalizes the AI tool, its ad revenue business as well. So that's sort of the broader narrative around Baidu. It's certainly played out in their numbers, because we saw the third straight drop in quarterly revenue. It declined 4% to largely meet analyst expectations. Adjusted operating profit also down more than 40%. Very big reaction that we saw in ADRs. So we can expect sort of the same measure essentially in the session in Hong Kong today.
Annabelle Druller's there, and of course, Bell will be back as we dig deeper into IDC's report with the group's Vice President, Brian Ma, on Bloomberg Tech Asia later this hour. We'll also break down the winners and losers of the memory chip shortage with Macquarie Capital's Daniel Kim. And we were, of course, talking about price increases for all of these electronic consumer electronics because of the shortage in memory prices. And of course, Sony is one big maker of those components, camera technology that goes into smartphones right now, gaining more than 6%. Sony expanding its ongoing share buyback program to as much as 250 billion yen. That's more than $1.5 billion. And that's double its previously announced 100 billion yen. This is really a part of a push to increase their capital efficiency. So we'll be following this stock as it continues to gain ground in the Asia session. This is Bloomberg.
Take a look at how oil is tracking at the moment. In focus, of course, US and Iranian officials agreeing to reconvene nuclear talks as soon as next week after talks in Geneva. Mediator Oman earlier saying both sides made significant progress in Thursday's talks. We are seeing that volatility in crude really reflecting expectations for a diplomatic resolution, or at least telegraphed military strikes rather than an extended conflict. So that does kind of add a bit more near-term risk back into lower crude prices. But let's bring in Bloomberg editor Michael Heath for more. So we've seen sort of a few headlines, talks have been intense, serious, positive. Some have not been so positive. What do we know, the scenario is? We're also hearing that the sort of military action side is still being considered, of course.
Yeah, Heidi. I mean, look, the reporting that's come out is that the US was a bit disappointed with and this is unsourced and not much more to it, but that they'd been a bit disappointed. But as you said, Oman, which is mediating the talks, and the Iranians are sort of more upbeat. There's going to be technical discussions next week, but bear in mind, next week is sort of when the deadline President Trump sent a week ago. That's due to expire at some time next week. Now, how significant that is, we're really not clear at the moment. But it's sort of it's almost a strange situation how they're talking there. The US has very, very sort of strict demands. It wants Iran to remove its enriched uranium, potentially to the US. It wants it to destroy its nuclear facilities and no sunset clauses on any deals. And it's only going to offer limited sanctions relief in response to that. Iran's basically saying that it's not going to give up any of its enriched uranium or any of those things, and it has a right to an industry. So it's almost like they're talking at cross purposes to some extent.
President Trump is seeming to claim that it could be an easy win, perhaps another quick operation in Iran like he saw in Venezuela. What are analysts saying? Because we're seeing this massive buildup of the military forces around Iran already.
Yeah, Shery, it's a really good point, because I think it's very difficult to say it'll be easy. Bloomberg's done some really nice reporting with satellite images that just shows that Iran seems to have been doing quite a bit of dispersing of its facilities, reinforcing the structures, and how much damage was done in June is really unknown because a lot of that was underground. But as you say, the US is reinforcing its military equipment and that's available there, including these new kamikaze drones that they have as well. So it's really difficult to see how it'll play out. It looks like there will be strikes, but what the end game there is difficult. And Iran just seems to be sort of talking around it as though that they can perhaps call the US's bluff. Now, I've seen it before that some of these Middle East regimes don't quite get how Western policy works, but it does look like we're on track for strikes. But to what end and how much can be done just from the air is really the question that remains to be answered.
Bloomberg editor Michael Heath there with the latest on geopolitical tensions around Iran, as we're also following some tensions around Cuba as well. The Trump administration's move to ease fuel shipments to Cuba's private sector is said to be part of a plan to make it more reliant on the U.S. for supplies. Sources tell Bloomberg the strategy includes reassuring energy companies they can sell oil and fuel to private Cuban small and medium-sized businesses and authorizing limited resales of Venezuelan oil. The move seeks to increase Washington's leverage to bring about political and economic change on the island. Afghanistan has launched a large-scale military operation along its border with Pakistan, targeting army centers. The attack comes after Pakistan carried out a series of airstrikes along the country's eastern border earlier this week. Pakistan says it killed 36 Afghan Taliban fighters in its response while losing 2 of its soldiers.
China has removed 9 military lawmakers from its national parliament in the latest sign that President Xi Jinping's purge of key defense establishment personnel continues to widen. Let's bring our China correspondent Min Lo for more on this. So what sort of detail do we know about these purges? How extensive, how serious are they?
Yeah, I would say it's quite extensive because these 9 people who have been purged come from many different parts of the military, including personnel from the armed forces, from the air force, from the rocket force, from the Navy, 2 from the Central Military Commission subsidiary departments as well. And if you look at this chart, you can see that President Xi has by far been the most extensive in his purge, particularly with the military, because his predecessors, Hu Jintao and Jiang Zemin, did not touch or purge any military generals. So what he's done is quite unprecedented. It also comes hot on the heels of the major purge last month when Zhang Youxia, who is the number 2, the former top general of President Xi, was also removed, and he was at one point seen as a very close ally of Xi. And of course, the signs have been there because even just recently during the Spring Festival, when President Xi met with the military personnel virtually to give them his Spring Festival greetings, he mentioned how this has been an extraordinary and unusual year in that the military has gone through in-depth political rectification and what he calls a revolutionary tempering in this fight against corruption.
The timing pretty interesting, right? Just a few days ahead of the full legislature meeting next week.
That's right. And the legislature meeting is when we would see new appointments of personnel, including political appointments, but also military officials as well. So you can imagine in the months leading up to this point is where you would see a lot of jostling for power, and perhaps why we are seeing some of these names being removed. And it also shows you just how extensive President Xi's purge in rooting out what he sees as disloyalty, right, towards the party, towards himself, towards the country, and also corruption as well. As usual, no reason has been given for these purges except for a serious violation of the law and of discipline. So we'll see. But it also sort of raises the question of just how combat ready the military is, especially given that if you consider the Central Military Commission and the top leadership members there used to be 7 members, but now only 2 remain standing, including President Xi himself and another newly appointed person that just joined the ranks in late 2025.
Bloomberg's China correspondent Min Min Lo there with the details. More ahead here on the Asia Trade. This is Bloomberg.
We're seeing a little bit of a divergence in the Japanese market today. We're seeing the likes of Sony and Nintendo gaining ground. Sony just surging after expanding its ongoing share buyback program to as much as $1.6 billion. Also, Nintendo, we had seen it being raised to outperform at local house Tokyo. So the price target now at 10,490. But then when you look at the chip sector, though, it's a lot of pressure because remember in the overnight session, Haidi, we saw Nvidia tumbling and dragging down almost every company in the Philadelphia Semiconductor Index.
Yeah, failing to offer any support despite another set of impressive numbers. Shery, let's take a look at the top corporate stories that we're also tracking at the moment. Netflix shares rising after the bell after dropping out of that fight to buy Warner Brothers. The move clears the way for Paramount now to clinch that deal with a Hollywood studio. Netflix says the deal is no longer financially attractive after Paramount's latest $31 a share offer. The streaming giant had inked an $82.7 billion deal to acquire the studio and streaming businesses of Warner Brothers back in December. Shares of Block closing higher in the US after the company moved to cut its workforce by nearly half. It is betting that AI will change the future of labour productivity. Block has invested heavily in AI tools to run more efficiently. The company has been restructuring its business model and staffing since 2024 as the stock has lagged. CoreWeave shares slumped in late trading after reporting a bigger than expected loss and boosting capital expenditures. There are concerns that the company might be overspending on the infrastructure. CoreWeave says this year's capital spending will come in at around $30 to $35 billion. That's more than estimated. They ramped up borrowing in recent years amid an industry-wide debt binge that has unsettled some investors. Anthropic has rejected the Pentagon's latest offer to defuse a standoff over conditions the company has sought governing the use of its AI software by the military. Anthropic says the new language proposed by the Pentagon as a compromise failed to satisfy Anthropic's desire to preserve key safeguards that it has sought for any military use of its AI tools. Those include prohibitions on mass surveillance of Americans. Syngenta Group is said to be renewing its bid to go public, this time in Hong Kong. Sources say it may raise as much as $10 billion in what could be one of the city's biggest listings. A Hong Kong listing would give Syngenta access to a wider global investor base and allow it to tap Chinese domestic demand. We'll take a look as we look ahead to the next hour of trading as markets open in Taiwan, mainland China, as well as Hong Kong. This is the picture. A little bit of divergence there as we see some upside for Hang Seng futures. Not a great deal of price action, but at the moment, of course, we are just seeing that muted to lower picture across markets that are already trading. We're seeing S&P 500 futures already being undermined by Anthropic as well. Take a look at some of the stocks that we're watching when markets do open in Hong Kong and mainland China. These market research reports from Counterpoint and IDC forecasting a double-digit drop in smartphone shipments this year will weigh on Chinese smartphone makers, no doubt. IDC noting that Xiaomi, Oppo's entry-level devices are most exposed to these cost pressures due to the memory chip shortage. That is it for the Asia trade. Bloomberg Tech Asia is next.